Well, good morning and welcome to the Reserve Bank. With me I've got John McDermott, who's the Chief Economist and Assistant Governor, and Willie Chetwin, who's the Head of Forecasting. The economic expansion has considerable momentum. Output in the economy has increased by around 4% over the past 12 months. Export prices remain high for most of our commodities, but dairy auction prices have fallen 26% since February, and log exports have been declining in recent weeks. Economic growth is also being supported by an acceleration in construction in Canterbury and elsewhere, and strong net immigration flows. House price inflation remains high in many parts of the country, but has moderated in recent weeks. The exchange rate remains high and has not yet adjusted to weakening commodity prices. The Reserve Bank does not believe the current level of the exchange rate is sustainable. Overall inflation remains low, but inflationary pressures are increasing. Above-trend growth has been reducing spare capacity, and pricing pressure is increasing in the construction and services sectors. How much the official cash rate will need to rise will depend on future economic and financial data and how these affect inflationary pressures. Our goal in the Reserve Bank is to keep future average inflation near the 2% level and ensure that the economic expansion can be sustained. Be very happy to take questions.
Governor, the bank's, your forward guidance is only marginally different from March. Are you sending the markets a message there along the lines of read my lips?
No, I don't think so. There's a lot of momentum in the economy. You're seeing that in terms of high export prices, albeit with dairy prices having fallen significantly, as I say, by 26%, and we're seeing log prices come off in the last couple of months. But there's still strong momentum in the economy. If you look at residential investment, if you take the last 2 years and in the next 12 months that we're forecasting over those 3 years an increase of 50% in the real level of residential investment, and we've still got strong migration forces working on the economy as well. So there's a lot of momentum in the economy, and we still see inflation pressures associated with the economy growing above trend rates of growth. I mean, we think potential output growth in the economy is probably around 2.75% or thereabouts, and over the next 12 months we're forecasting growth of around 3.5%. So we are starting to see pricing pressures in the non-traded goods sector, particularly around construction and some of the other services sectors. So this is our central forecast of how we see the interest rate track. Now, what we have done in the monetary policy statement is produce some fan charts, if you like, that indicate the degree of potential volatility based on past data. In this case, it was data taken over the last 22 years and looking at correlations between various variables and what sort of volatility or standard deviations are affected in the relationships. So we've tried to emphasise the fact that these are conditional projections and that there is uncertainty around some of the projections around key variables such as output gaps and interest rates.
two alternative scenarios you sketch, one with stronger migration and one with lower export prices. Do you have any sense of which of them is the more likely, or are those risks kind of balanced, do you think?
Well, I think there's uncertainty around both of them. If you take dairy prices, they've come off 26% since February. We're forecasting that they'll decline by around another 12% over the next 12 months, with most of that adjustment taking place in the next few months. On the migration side, we've built in basically a migration cycle, if you like, of around 100,000. In fact, to be exact, it's 102,000, but that's spurious accuracy. But we've built in 100,000 increase in the working force or working age population. Now, that's about an increase of 3% of the total working age population. Now, there's a lot of uncertainty around how strong that migration increase will be. If you go back to 2002 to 2004, the increase in net migration was around 70,000. So we've built in terms of this cycle, an increase in net migration of around 100,000. But we did put in a scenario that said, well, what if migration was even stronger than the 100,000? So there's uncertainty around both those things.
Governor, you've mentioned the drop already in the dairy prices and forecast another 12%. How concerning is that? Is that to the Reserve Bank a big concern, a further drop of 12%?
Well, I think it's significant. I mean, if you take dairy exports, they're basically about a third of total merchandise exports for New Zealand. So that's significant. And if you look at the effect on dairy farmer income, we think it's roughly around $2.25 billion over the next year. And that's, if you take GDP here, it's roughly 220 billion. So that's a 1% decline in real incomes, if you like. So they are significant.
You've got the household savings rate continuing to, but the recent years' improvement to be sustained, which sounds quite good, except when you sort of realise that the improvement is still negative. It's just not as negative as it was. Should we be worried about that? Are you worried about that?
Well, if you take the household savings ratio, say over the past decade, it's averaged about, I think, roughly about 2.75% negative of disposable income. So this is an improvement, but it's not a strong improvement. We've seen the household savings ratio improve since the global financial crisis, but it hasn't had the improvement that you've seen in many other countries, for example, in Europe, or indeed the improvement that you're seeing in Australia. So if you look at our forecasts of the current account deficit, for example, then you see quite a significant deterioration in the current account deficit in the outer years. And that's a corollary of low national savings relative to strong investment flows, many of which are linked to Christchurch.
Governor, how much of a concern is the potential continuation of strong migration to the housing market, and would you like to have any ability or like to see any policy changes that would curb that migration flow if it got too strong?
It's certainly a factor, in terms potentially of the housing market. Migration is in many things a very positive force for the economy, particularly if it involves increasing skilled labour being available in the labour force. So there are demand and supply side effects around the migration. What tends to come through, if you look at historic experience, the demand side impact tends to come through first in the economy. And that will be reflected in higher housing demand. What we're seeing this time is that maybe the impact on aggregate housing demand may not be as strong as in, say, for example, the 2002-2004 cycle, because a lot of the net migration is due to New Zealanders staying rather than departing the country. And also a lot of the arrivals are tied into work permits, temporary work permits. So it's possible that we won't see the same dramatic impact on house prices that we saw in 2002.
Just wondering, do you see any merit in curbs on immigration, or is that a futile exercise to try and guess when it's turning?
I think you hit it on the head. It's very hard to fine-tune immigration to meet demand purposes. By the time you make an adjustment, you may well find the situation's completely changed.
Governor, is it fair to assume that you will pause your policy tightening sometime soon to assess the impact of the increases you've delivered so far? And secondly, inflation is slower than you had expected it to be. You've lowered your inflation forecasts today. Can you give us some sense of what that might mean for your tightening cycle?
We've put together what we believe is the most plausible path of the economy. I mean, they're based on conditional projections, so there's all sorts of assumptions embedded there about the terms of trade, about the exchange rate track, about the investment in Canterbury, what are we assuming about migration and all that. So it's all highly conditional. But these are our central projections. But we also recognise there's a lot of potential uncertainty around a number of those key variables. And that's why we produce the fan charts that were in there. So at this point, the interest rate profile that we've included is our central projection, albeit with a lot of uncertainty around some of the variables. In terms of the future, I mean, we'll be guided very much by the economic and financial data that will become available. So we'll look closely at what's happening with the exchange rate, what's happening with inflation in the non-tradable sector, what's happening to house prices. We'll look at the GDP numbers that become available and the new inflation data that comes up. Did you want to comment on the inflation, John?
I mean, if you think about, we had an outturn that was a little bit lower than we expected by a small margin. It takes about a year to get very close to the midpoint, and that's very typical. From there on, we stay very close to the midpoint, subject to no other surprises. Abstracting from some administrative changes like ACC, which will be lower in 2015.
You're projecting that annual net migration will peak about now at 37,000 and then decline. What are the reasons why you think it might decline from here?
Partly, there's uncertainty, as we've talked about, around all of this. And as I say, we've built in a total flow, net flow over the cycle of 100,000 working age, increase in working age population through net migration. Yeah, we think it's currently running, if you take working age population, it's running at around 32,000 at the moment, 31, 32. We think it'll probably, or at least what we've put in our forecast, we've got it peaking at around 30, 36 or 37 by around mid-year. The migration flows here are linked quite closely to what's happening in the Australian labour market. We think the Australian economy is on the right path, and that employment prospects will increase in the Australian market, and that will have some impact. But let me see if John wanted to add anything.
That covers most things, and it really is. The timing is dominated by what we think is going on in Australia. We also recognise for the last quarter or 2 quarters we've been a bit surprised by the strength of net migration, and so we do have to be on guard and be a bit apprehensive about exactly where the turning point is, because it could be another 3-4 months out.
I think in December you were talking about the sustainable growth rate of the economy being around 2.2%. Has that changed at all?
I think at the time, forgive me, I think at the time I said about 2.75%. 2.75%. In terms of potential output, that's what we've had for a period of time. But John, did you want to comment?
Yeah, I mean, we have edged up slightly given the information we have. Particularly one is net migration certainly adds to labour supply. Also, people in the economy are now more willing to work, so labour market participation has increased. All these factors will add to the supply in the economy. And we're also hopeful that the increased investment that we're starting to see will increase the capital stock and also improve potential. So those are the factors we've been watching, and we've been just edging up ever so slightly.
Well, we have a traffic light system that I think the market's pretty familiar with. I mean, there's several steps that we look at, one of which is whether the exchange rate's at an exceptional level, whether the level of the exchange rate is justified by fundamentals, and whether intervention would be consistent with the policy targets agreement and whether it's opportune in terms of financial market conditions to intervene. So we'll keep looking at the traffic light system and see whether those 4 tests are met. I'd rather not comment on just what the lights are saying at present.
Governor, what's your latest thinking on the effect of LVRs?
We think they have been effective in meeting the objectives that we set for them. If you look at house sales across New Zealand, they're roughly down around 12% on average compared to where they were at the beginning of September. Auckland's down a bit more. It's down about 14%. And if you look at some of the modelling work that we've done in the bank, which is always difficult because you're trying to work out what would a counterfactual be. And as you know, with these loan-to-value ratios, we introduced them at a time where the banks were competing very aggressively to lend to people with low deposits. I mean, that ratio had got up to around 33% at one point, that a third of the lending was going to people with deposits less than 20%. So that has come down to around about 4.5 to 5.5 at present, and that's, as I say, reduced the volume of sales, and it's reduced some of the pricing pressure. So the modelling work that we did suggests that house price inflation for New Zealand as a whole would probably be running at around 2.5 to 3.5% higher than it currently is. So the most recent data, and there'll be data I think out tomorrow, which will be the RINES data for May, but the most recent published data suggests that house price inflation is running at around 8.5. So without these measures, we think it would have been running at around 11 or 12.
Governor, how confident are you that the trade wages index will start to abate this year? And isn't it unusual to have it peaking just at the time when we're starting the tightening cycle?
Well, there's a strong correlation over time between terms of trade and the exchange rate. If you look at the New Zealand data, there's a strong correlation. And we've seen, as I say, we've seen dairy prices decline 26%. We're projecting further declines. They account for about a third of merchandise exports, and we're seeing some weakness in log prices. So we've been surprised that the exchange rate hasn't come off in response to the commodity prices, and we expect that it will. We don't think the exchange rate can be sustained at at these levels.
Just on another matter, you've had success with the LVR policy. Are you looking at any other discrete policy tools that you could adopt, or would you like to be able to bring in other short-term policies to sort of hit the market and then back off?
Well, as I say, the loan-to-value ratios we think have been very effective, and we'll always look at possible ways of extending the toolkit for the macroprudential instruments. But at this point, we don't have any plans to introduce additional instruments at this stage.
Is there any concerns? Some of the banks have been cutting fixed rates recently, and there seems to be some cheap money floating around. Is that a concern that it negates the impact of OCR rises, and do you see any sort of threat of a mortgage wars and those sorts of things?
Well, what we would like to see, if it could be achieved, is, to be blunt, we would like to see a lower exchange rate and higher long-term interest rates. The higher long-term interest rates would assist our objectives on the housing market, but a lot of that's driven by what's happening offshore. And if you just take Europe just for a minute. If you look at 10-year bond rates, 10-year bond rates for Spain, they're at 250-year lows. Their 10-year rate is below that of the US at this point. And, you know as well as I do where Spain has been in recent times and still is. The same is true with France. I mean, French 10-year bond rates are at 250-year lows. Even Italy are at 200-year lows, except for a few months in 1945. So that's the sort of pressures that you're facing in terms of international financial flows, and that's putting downward pressure on long-term rates. If you look at the duration, the interest rate duration of the mortgage market here, it's by international standards, it's very low. So if you take the average time to reprice mortgages in New Zealand, it's still just under 10 months. So I think the bank still has plenty of leverage in terms of interest rate policy.
Governor, the monetary policy statement includes a scenario where net migration rises significantly over 40,000, which you say could increase short-term demand pressure on the economy and potentially increase short-term interest rates and the exchange rate. Do you think there's a case for the Reserve Bank to look through the surge in net migration in the same way that it looks through, the government changing some policy on prices?
Let me ask my chief economist.
I doubt it. Excuse me. And the key reason is, if we did see that extra net migration flow put pressure on the system, we'd generally start to see prices increase. And while that might not matter in the first 6 months, in the first year, eventually people will get used to those increased prices. It would embed itself in inflation expectations. People would start to demand that in their wage claims. And then all of a sudden, what you thought was temporary becomes permanent in the system.
What are the risks, do you think, that we face the same problems that we had between 2004 and 2007?
If you look at the current flows in terms of borrowing decisions, I mean, roughly 70% of the new mortgages being printed are fixed-rate mortgages. 30% are going into floating. And if you look at, say, what's happened since March, when we started the tightening cycle, then floating rates are up about 50 basis points. If you take the 6-month to 1 year maturity, they're up about 40 basis points, but they're down 20 basis points for 2-year and 3-year rates. But as I say, the interest rate duration of this market is low, certainly by international standards. I mean, take the US market, the standard mortgage is a 30-year fixed mortgage. So when we've got fixing, it tends to be out to 2 to 3 years, sometimes a little bit longer, but not much. So, as I say, the average time to reprice mortgages is just under 10 months. So we're not concerned that we'll lose traction on monetary policy. We still think it carries quite a punch.
Governor, has the economy produced the wage growth that you would have expected? Is wage growth lagging?
I guess the way I'd put it is, you've got an economy which, over the last 12 months, output's probably increased by about 4%, and employment growth has increased by about 3.5%. And if you sort of stood away from New Zealand and said what you know about the characteristics of this economy, is it feasible that you could have growth above potential output, growing quite strongly, and see very strong employment growth, but not see it coming through in wage price inflation or wage inflation? And that's been, I think, a bit surprising that wage inflation has remained as moderate as it has. And it's largely due to two things. It's largely due to, in essence, the growth in the labour supply that we're seeing. We're seeing higher participation rates, more people are looking for work, what we call an added worker effect, and you're seeing strong migration flows that, and particularly around Canterbury, for example, with skilled workers coming in there. So I think the elasticity or the supply response has accounted for that. But, as the labour market tightens, due to continued strong demand, and if these migration flows or participation changes, then you will start to see increasing wage pressure coming through.
Just switching back to the exchange rate again. You've sort of been saying for, I think, at least 2 years that the current levels of the exchange rate are unsustainable, and yet we seem to have sustained them. And I'm wondering if you're sort of getting a bit tired of jawboning. It does seem as if, effectively, the market is just sailing on with exchange rates at these high levels.
Well, as I say, there's a strong relationship between terms of trade and the exchange rate, and the terms of trade have been rising quite significantly. I mean, they've been at 40-year highs, and that's a key factor. But as we all know, the unconventional monetary policies that are being adopted by many central banks overseas, in terms of interest rates close to the zero band, forward guidance that often extends out for another couple of years, in terms of interest rate intentions by those central banks, and the fact that they've injected over $6 trillion into the global economy. That's also been a factor, because it's also led to a lot of yield compression in terms of investors basically looking around the world for higher yielding assets, and New Zealand has been, to this point, an attractive destination for those flows. But did you want to add anything, John?
That's fine.
Governor, the GDP quarterly growth figures going forward look a bit anemic compared to where we've been at. I just wondered what your sweet spot was for GDP growth.
Well, what we're trying to do in terms of monetary policy is, in essence, sustain this recovery. If you look at what are the factors that could cause this recovery to stop in New Zealand, cause us to go into recession, for example. Then, if you look at global growth and you look at the IMF forecasts, the OECD forecasts, you in fact see global growth starting to pick up over the next 2 years. So that doesn't seem likely. It could be a shock to the terms of trade, and that would probably have to be China-related. And there are some question marks around construction activity in China at the moment, but nobody's forecasting that the Chinese economy will grow anything less than 6 or 7% over the next year or so. It could be if there were large policy mistakes around fiscal policy, but you've seen both the main political parties talk about prudent fiscal policy. And so I guess one of the most significant risks is what if inflation pressures started to build up in this economy and started to erode competitiveness and the growth in real incomes. And that's what we're trying to avoid. We're trying to raise interest rates that will, in essence, slow the rate of economic growth down a bit, keep inflation expectations contained at around 2%, and basically enable this economy to continue to grow at a steady rate. That's what we're trying to achieve. James.
Governor, your projections suggest that borrowers face another 200 basis points of interest rate increases in the next couple of years. What sort of implications does that have for the housing market? Do you see this pulling the housing market right back?
Our forecasts build in quite a slowing in house price appreciation over the next 2 years. And that's a combination of mainly the interest rate rises that lie ahead, but also perhaps some easing off in migration flows and a continued impact, and we're unsure how long it will continue to be an impact around loan-to-value ratios, because we've always said we see these as temporary measures.
Governor, last night the World Bank reduced its forecast for global growth again. What's your assessment of whether there's some structural changes happening in the global economy that mean we get significantly lower inflation and growth than we should be getting, given past records, and what impact that might have on New Zealand, because we seem to be getting this significant difference between our interest rates and our inflation and the rest of the world's?
I haven't seen the World Bank's forecasts, but if you take world output, it's currently growing at around 3.75%, which is pretty well around the average of where it's been. In fact, it's a little bit over the average where it's been over the last 20 to 30 years. The big difference is that it's been achieved by enormous stimulus in monetary policy in the advanced economies. The interesting puzzle, I think, in many economies is what's happening to productivity, what's happening between the output and the employment relationship. You're seeing quite weak recoveries despite all this monetary stimulus that's been applied. So some of the recoveries, if you look at the US, you look at Europe, you look at, well, Japan's had a problem for quite a long time in respect of stop-start recoveries. But they've been weaker than past recoveries. But you've also found that employment growth relative to output has been quite strong. In other words, productivity has been weaker than what was anticipated. And I think people are trying to work out what's causing that relationship. But let's see, did you want to add anything, Joe?
Well, I just want to stress the fact that, of course, we think the New Zealand economy is growing around 4%, which is a pretty healthy growth rate. And when other economies are having structural difficulties, perhaps in the Northern Hemisphere, you'd expect, as a net consequence, some difference in our interest rate profiles because of that. We probably should be thankful we're not in their position, actually.
But the end result is we have this very high currency, which is making it very difficult for exporters. And
it's one of the consequences, but the end result is we're growing at 4%, we're generating jobs, and income growth is positive.
Well, thanks very much indeed.